Let's say you own a local taxi company called Kuma Cabs. You are the CEO and you handle the company with some early investors, which includes your friends and family. After some years, Kuma Cabs is going very well with profits all over the reports every quarter of the year. Then you and your investors are coming up with the idea of making the company bigger, scaling up to a nationwide level company, and expanding existing services to all over the country. But you have a problem, and it's very common. You have money issue. You'll need tons of money to develop your company and make it bigger. Because of this, you have to initiate a meeting with your investors to find out the solution of the problem. After quite some time, a result comes out. You guys decided to make the company public through an IPO process. So what is an IPO and how does it work? Well, you are watching communication, so let's talk about it. IPO or initial public offering is the initial sale of the company stock to the public. There are some advantages if a private company turned into a public company. You can raise capital money without increasing debt, expanding services or develop new branches, and making profits by liquidating your shares. But this process is not free nor easy. You'll need enough fund for additional costs in legal, marketing, and accounting. And there are so many requirements and documents to be filled before you can make your company public through an IPO. A private company will be held by third party, one underwriter or more, according to the size of the company's asset. Underwriter is usually an investment bank that helps private companies underwrite the public offering of the shares. Let's go to an underwriter called the bank. Your company and the bank are going to determine IPO price, amount of shares, and percentage of your company's shares that will be given up based on your company's value. The bank values your company at $100 million. Then you decide to sell 20% of your company. 20% of $100 million is $20 million. The bank will continue by issuing the amount of shares. Let's say they issue 10 million shares for the public. $20 million of value divided by 10 million shares would make it $2 per shares as the end price. After the amount of shares and the price is settled, the lead underwriter went to other underwriters to gather as a syndicate, allowing other institutions to get involved. Your company and the syndicate then develop a prospectus. Prospectus is a formal legal document designed to provide information and full details about an investment offering for sale to the public. Then you and the syndicate register it to the Securities and Exchange Commission, or SEC. You will get purchase commitment from other banks, brokers, or institutional investors. Then these groups will hold the shares for a period of time until it will be available for generally high-valued investors as an exchange. This placement share process is called initial public offering. After this process is complete, the shares will be available to trade in the stock exchange. From this point, the price is determined by the market, not by your company or underwriter anymore. Now, Kuma Cabs has become a public company and you'll have enough money to expand your services and you will be able to liquidate your share to get profits for yourself. This is what we call an IPO process. Thank you for watching.